one of the things that is very topical is the wealth tax, which is obviously land tax. So how does that apply to me? And obviously, depending on what entity I'm in, there's different rates. Is that correct?
Correct. So an individual has a threshold of $600,000, where a trust or company has a threshold of $350,000. So that's one consideration we need to take in when we look at when we're giving the advice as to how to structure the property. If you've got existing properties, then we need to take a look at the value of those. You know, what are the land tax implications? Because it can work out quite expensive. You're coming back up on it.
So obviously that's in Queensland. So in Queensland, every state is different and they have their different rates. So if I'm, like I've got properties in, because I have my own business, so therefore the advice that we've been given is to put them in different trusts and whatnot, and companies with corporate trustee. So on some of my properties, I've actually now am paying land tax because the values of those have gone up. But is it based on the value or is it based on the unimproved capital value? Which is
the unimproved capital value. So basically your rates notice, what's on that?
So really, even though your property might be worth $600,000, it's really based on the unimproved capital value.
The land value.
Yeah.
So I've actually got multiple trusts with my properties in, so I've been, I wouldn't say avoiding it, but
every purchase is in a different trust.
Yeah, yeah.
So you can, if you've got 6 properties in one state, you can have them structured with different owners, different trusts. Is the tax office onto that? Do they?
Well, it's quite strange that in Queensland, you know, you could have multiple trusts with multiple properties in them, and they're actually not assessed as a group. They're assessed individually. Okay. So you can avoid that land tax until the value does increase, which it does happen over time. But if you can avoid that for 10 years, if you can avoid that for 10 years, that's a lot of money.
But in the day, it's not in the day still a tax because I'm obviously got a property that's actually grown in value or worth a certain amount, and so therefore it's not a tax I like. I don't actually agree with it, but it is what it is. And
but it's important to be across though, because we're talking about, or New South Wales in particular, talking about phasing out stamp duty and having a land tax that all property owners pay. Yeah. So it could become increasingly an issue.
Well, stamp duty was supposed to go with GST, introduction of GST as well, but they kept that. It's another tax they kept.
Yeah, but New South Wales wants to phase out stamp duty and replace it with a broad-based land tax.
And that can have massive financial implications to long-term property owners because, you know, you're going to be, rather than just a one-off cost, which is a capitalised cost, which you can then take off the capital gain because you can't claim it up front, correct? Yep. And he's taught me well. But it's something that you can claim off. So if I make 100 grand, I've got stamp duty of 20, then my capital gain's only 80,000.
Yeah, and sale costs and solicitors' fees, they're all what they call capital costs.
But the the land tax, it's an annual thing. And so it can be, and this is, I know in the US, it was a very big thing. We had someone we knew over when the GFC hit over in the US, people had no debt on their property, but lost their property because they had massive property tax, which they paid every year. And it based on the value. So it's an interesting...
I think we need to be very careful what we allow them to do with that, because once they, they're very insidious, some of these taxes.
They don't like getting rid of taxes.
No.
And if they're going to replace with another tax, I'm sure it's going to be making them more money rather than saving us money. So it's...
In the ACT, they're phasing out stamp duty. Yep. They're doing it in increments. And they're saying, well, that's great, you're paying less stamp duty, but actually what they're doing is they're increasing rates to more than compensate the revenue they're losing.
I think that's what they actually did with council rates when they demalgamated, and they did water rates and council rates. Yes. You know, it used to be all incorporated, but now it just seems to be more than what it was previously.
100%. But they've got to argue that it's all got to go to infrastructure, which we need to do. But just going back on the land tax too, is... if I'm buying with my partner and we have it in our own names and we're on a 70-30 split as tenants in common, we've got a $600,000 limit. Effectively, or let's say it's 50-50. Really, we've got 600 each, haven't we? So combined, we can have up to $1.2 million worth of property.
So we could actually have situations where we do a ownership you know, a property split where we might do a 70-30, where one partner will get a land tax assessment and the other one won't. So, you know, it's your percentage of that property that you get assessed on.